Well, hi everyone, Shaun Humphries here. I just wanted to put together this screencast video to give you an investment update specific to the Select Income Managed Corporate Class investment structure. This is an investment option that we've used quite a bit for clients for that portion of the portfolio that needs to be quite conservative, and so I want to give you a bit of an update. So Alfred Lamb, who is the Senior Vice President, Chief Investment Officer of CI Mulit-Asset Management, provided a bit of an overview. So with this video, we've also uploaded this particular update, so feel free to view it on your tablet, computer for more information. I'm just going to highlight the document, draw your attention to some of the more important points that Alfred outlines in this particular report. Now, just by way of review, this particular portfolio I've historically recommended to clients is really an alternative to GICs, Guaranteed Investment Certificates, and T-bills. So the challenge with GICs is to get a yield that's relatively attractive, and 5-year GICs, that's there in the range of 2.25% to 2.5%. And in order to get that yield, you need to lock in your money for 5 years. And for a lot of people, particularly during a period of slow incremental rises in interest rates, that's not a very satisfying option. Locking up the money, having no liquidity to get that kind of yield. And so the Select Income Managed portfolio is an alternative. What we like about it is, number one, it's liquid. Number two, it's provided returns above the risk-free rate here pretty consistently. And although the portfolio is in the market, in other words, they're buying corporate debentures, government bonds, preferred shares, REITs, a little bit of equity investments. They have done extremely well in managing risk, short-term risk. In fact, if you go back historically, there's never been a year where they've lost money as it relates to capital markets. Even in 2008, they didn't lose any money. So we think it's a great option. And really, when you look at this portfolio, generally speaking, although it's very conservative, I usually say to clients, look at it in a 2 to 3 year window. So there can be a little bit of short-term volatility, but if they view it as a 2 to 3 year hold, then it's our expectation that the performance will come in line with what the managers are trying to achieve. So Alfred gets into a little bit of a discussion on market conditions, and what he talks about here is what I've sort of highlighted as the Trump bump. So we saw equity markets doing extremely well after the U.S. election back in November. There was an expectation for rising growth, and that means rising interest rates. And as a reaction to that, the bond market's gone a little bit down. Of course, the stock market's gone a little bit up. So we've seen a diversion between those two asset classes. That diversion probably is going to start slowing down a little bit, but certainly it's been one of the main themes of capital markets over this last year. We've also seen the Bank of Canada begin to raise interest rates, and some of the interest rate increases were a little bit surprising. We have a fairly anemic growth in the Canadian economy. It's certainly improving, but over the last little while, there's very little inflation. There's really no wage pressure. There's none of the typical reasons that you'd see the Bank of Canada raise interest rates. Likely one of the reasons they raised rates was a concern about a flood of capital leaving Canada for other higher yielding markets, particularly in the bond market. So the U.S. interest rates have been going up. The rates were creeping above Canadian rates. And so what you see is downward pressure on the Canadian dollar. By raising rates, it sort of stems the tide of capital flows from Canada back to the U.S. With investors trying to find better yield and putting money in what might be perceived to be more secure debt instruments. So the rise in interest rates certainly led to a bit of a bump in the Canadian dollar. And there's been some stronger demand for Canadian commodities that's really helped that. So Alfred talks a little bit about that in the context of this last year. So if we look at performance numbers, basically the 3-year number, if we go at the last 3 years, the net of fee returns are 2% a year. The F class, which you've used for a lot of the fee-based accounts, the net of fee return is 2.9%. And so that gives you a basic sense of the performance. If you look at longer term perspectives, the 5-year return, 3.4%, 4.3%, 5.5%. And so that performance is right in line with the expectations for the portfolio, a conservative, liquid, low-risk investment option. Alfred then goes on to talk about outlook and positioning, and so he believes that government bonds are attractively priced. So as interest rates have been going up, we've seen bond values trending down a little bit. So he believes that there's a buying opportunity to go back into the bond market. They don't see interest rates to go up in any significant way. And one of the reasons for that thesis is, even though rates have gone up a little bit, he talks about the unprecedented level of debt. So if you look at consumer debt and government debt, it's very high, and they feel that that will be compressing the potential upward increase in interest rates over the next little while. They continue to diversify the portfolio and have a little bit of an equity weighting to try to achieve some additional growth in the portfolio, but they continue to be very cautious as it relates to the stock components to the portfolio. So that's the basic overview, and we've got this attachment on the webpage. And if you're viewing this particular video on our YouTube channel, there's a link that will take you to this particular document as well. So I hope you found this presentation helpful. If you have any questions, don't hesitate to contact the office, 204-977-8022, or you can send us an email or visit the website, and the email contact information on the website, and that's www.shaunhumphries.com. Have a great day. Bye-bye.